Okay, welcome everybody to today's webinar on converting legacy pensions. So I'm joined by the founder and CEO of Smarter SMSF, Aaron Dunn. Welcome,
G'day,
Aaron.
Javen. How are you?
Very good. How are you?
Very well, thank you. Looking forward to today's session.
We've got some big numbers attending, which is always very exciting for a niche, I guess a niche topic like this as well.
Yeah, absolutely.
Also joined by Tim Miller, who's the SMSF Technical and Education Manager for Smarter SMSF.
G'day, Javen. How you going?
Very good. So I guess, guys, before we make a start, I suppose a bit of housekeeping. So today's session will be recorded, so everybody will receive a link to the recording, and will be published on our YouTube channel. And also everyone will receive a copy of the slides from today. So if you do miss anything, don't worry, you will get access to recording and you'll get access to the slides. So I think, Aaron, before we get too far down the weeds, do you want to maybe give everyone a bit of an update? I guess not update, best. Who is Smarter SMSF? Because not everyone may be aware of who they are.
Yeah, thanks, Javen. Many of you may have seen me. Javen, you and I have been doing BGL updates together, I think, for 2 years. So many of you will know that we work within the technical and education space and specifically around SMSFs. And we have both our education solutions. Some of you may have utilised our SMSF course content, which is available through the BGL education area. You may have attended SMSF Day events, which we recently held. Or you may use our documents via the document platform where we have a range of SMSF legal and pension and compliance documents as well. So got myself and Tim on today, and Tim is the absolute guru when it comes to this stuff. He was involved also in the Treasury discussions with this, so he can give some wonderful insights. And I guess from our point of view, this is an area that's right in our wheelhouse, both by age. Tim and I sort of cut our teeth on this stuff way back in the early 2000s. Probably worked with Jeevan, yourself, and the team when these were around in the Simple Fund desktop as well, about how we needed to deal with these as well. So, yeah, really going to impart our knowledge around these types of pensions and the opportunities that present from these new regulations that have been introduced.
Sounds exciting. I think, combined, we probably have over, 60 years experience in the SMSF experience.
Yeah, between
almost a retirement age combined, huh?
Yeah, that's right. All right, well, let's get things underway. And you're going to hear from all three of us as we work through today's session, because we want to not only give you some of the practical information, we also want to be able to give you technical content, and then how you need to deal with this in the context of your SMSF clients and BGL software as well. So you're going to, as I said, you're going to hear from all three of us as we work through. So what are we going to cover? We're going to cover what these regulations are now about. We're going to dive into the types of pensions that this amnesty covers. So specifically, market-linked pensions, which is really the largest area of these measures. So we know there's many thousand, Jeevan, I think from memory, on Simple Fund 360. So we know that there is a large cohort of clients that might have 1, 2, 5, but there's not many firms that will have 15, 20, even 100 of these types of pensions. So understanding all the nuances to this is really important. We'll also look at the defined benefits. So if you think market-linked pensions are small, defined benefits are much smaller again. So there's two parts to this process, and Tim's going to take us through these defined benefits and the reserve allocation rules and how they have changed. I've touched on, I guess, the aspects of how we'll tackle this, both from a technical and a practical and the software considerations. And then we're going to dive in and show you what we've done on our platform around the formulation of what we call a legacy pension hub. So these are the tools, these are the documents and stuff that you'll need to be able to successfully work through and ultimately comply with what is needed when you are looking to unwind one of these superannuation income streams. So let's get stuck into it. Treasury, through these better targeted super concessions, so we're talking about the Div 296 analysis, identified around 16,900 SMSF members supposedly with one of these legacy style products. Now this, the reason why this started to get highlighted as an issue is with these Division 296 tax measures, it was going to require these types of pensions to have to be valued each and every year for total superannuation balance purposes. Now, that was going to create significant additional cost to this process. So much to the relief of the industry, we then saw draft regulations released in September of 2024, and then the finalisation of these regulations after consultation in December 2024. And it provides for this 5-year amnesty period around commutations. The reserve allocation rules are permanent in nature, which I will get Tim to talk to shortly. But these rules, these regulations have in essence kicked off since the 7th of December last year after they were registered that previous date. Now, these are regulations. So, Tim, I'm going to hand over to you here because there are some important aspects to this that we need to understand about how regulations become effective and then what may occur if there is a motion of disallowance.
Yeah, thanks, Aaron. So I guess the key thing with these regulations is, so as Aaron's highlighted there, they were introduced in December. Now, the thing with these regs as such is that they effectively become in force immediately or the day after they're registered. Now, what they then have to go through is a disallowance period, which is 15 days, 15 sitting days of Parliament, where anybody can put a motion to disallow the regulations for whatever purpose they see fit. Now, let's be clear here, there's no expectation of a disallowance period being put in place with regard, or disallowance motion being put in place here. But the quirkiness of these regulations is that they were introduced just before Parliament broke for the Christmas break. And so the sitting day period only started once they were tabled in February. And as we all know, we're in the midst of a federal election, so the sitting days is also paused. And so the disallowance period will end approximately 6 days, maybe 7 days after Parliament resumes. And if no motion is placed, which is, as I said, is what we expect, then we will see these regulations fully in force and effectively unchallengeable moving forward. But the key thing is that they are in force now, and we can commute ever since the 7th of December.
Yeah, so Tim, let's now break down what the actual regulation, so that Treasury Laws Amendment commutation, legacy retirement product commutations and risks. I've never seen a short bill or regulation. I don't know whether you guys have, but you usually need to take more than one breath.
Yeah, look, and it's actually quite a simple set of regulations. Whilst we're talking about sort of complex measures in the sense of legacy pensions have some complexity around them, the measures themselves are actually quite simple. There's 2 parts to it. One, which is introducing a measure within the SIS Act to allow for the commutations of these previously non-commutable pensions, and that's part 1 of the regulations. And then part 2 is effectively income tax regulations, which provide for allocations from reserves to either be cap-free allocations or captured against individuals' non-concessional caps versus concessional caps. So it's ultimately a relatively simple set of regulations that come in, but it's then understanding all the technicalities behind it when you're directly sort of addressing your clients as such.
Yeah. So we're going to spend today actually breaking down part 1 and part 2, because there is an amnesty that in a 5-year time frame that relates in essence to part 1, and then there is a more permanent nature that relates to part 2. And as we look at those 2 items in isolation, you'll then see the importance of the steps that need to happen within each of those actions. So Tim, I'm going to get you to now expand on what these commutation rules allow for under this amnesty period.
Yeah, so look, I guess before sort of we talk through the advice piece, and then I'll hand back to you to do that in a moment, Aaron. But I guess the key thing is that what we are looking at here is 3 very specific types of pensions, and ultimately, if we're being sort of really crystal clear, largely 2 more than 3, and that is our market-linked pensions, which are our account-based pensions, then our lifetime complying pensions, and our life expectancy pensions. Now, we reference life expectancy pensions. If there's more than two handsfuls of these still in existence. That would be some form of miracle, because most of them had a life expectancy that did not exceed 20 years. And because they were all started before 2006, most of them have reached the end of their term. But the key thing about these pensions, and they're called, the collective term is compliant pensions, is all of them were established before 2007, or in the case of a market-linked pension, are the result of stopping a lifetime or fixed term pension and commencing a market-linked pension after 2007. So these are not new pensions by any means. They've all been in place in most instances for upward of 20 years, which makes the concept around finding data about them often a challenge from an accounting administrative point of view. But the key is it's only about these three pensions. The requirement of the regulations is very simple. If you choose to commute the pension, so if you choose to stop the pension, it is a decision to be made in full. So it's not we want to leave part in the pension and stop and get access to capital for another part. It's a full commutation requirement. And then the regulations basically leave it open-ended as to what you then do with the proceeds. So the options become, we choose to commence an account-based pension, which is going to be subject to an individual's personal transfer balance cap space, what they can do there. We can take the money out as a lump sum, or alternatively, we can leave the money in accumulation. Now, the key there is, if we are the recipient of a reversionary pension, then we're already in receipt of a death benefit, and we know that death benefits cannot be rolled back. Death benefit pensions cannot be rolled back to accumulation. So if it's a reversionary beneficiary, the money must come out of super or be put into a death benefit income stream if there's space. And probably the key thing is, for a lot of these clients now, a lot of these pensions are still in existence because they still have asset test exemption and a link to Social Security. And one of the key issues with that was, when the measures were announced, they were announced as such to say, okay, well, if you commute your pension, you will lose your asset test exemption. However, the government ensured us that nobody would be assessed or have a debt raised by Centrelink on that commutation. Now, the crux of that piece is that it's all well and good for the government to say it, but we need that confirmation by Centrelink, and we've seen the Social Security debt waiver introduced on the 26th of March, as you can see on the date there, and that provides the Secretary of Social Security, which is like the Commissioner of Tax as such. It provides the Secretary of Social Security with the power to waive a debt if one of these pensions is now commuted. Now, there's ultimately two levels of debt here. There is one is, in theory, if you commuted the pensions, then you broke the rules as they were put in place many years ago. So a debt waiver is in place there. But also, if you change the rules of your fund to allow for the commutation, so even if you don't commute, but you change the rules to allow for it in the future, then in theory, you're also in breach of the Social Security Act, and this debt waiver extends to those that amend their rules. Now, the key thing here is that this is also subject to a disallowance period, and that disallowance period is 15 days, but these were introduced the day before effectively Parliament ceased for the federal election. So we have to wait the 15 days from Parliament resuming before these measures absolutely take effect. Now, again, we're not expecting anyone to put a disallowance motion in, but it's just, we kind of take the approach with, if you're dealing with asset test exempt pensions, don't act too hastily, because there's a less than 1% chance, but there's always a chance that these measures don't go through. But there are times when potentially you will look at commuting the asset test exempt ones, but you've got time on your side with the 5-year rules.
Yeah, so I think the other thing, Tim, there is yes, there would be the importance of seeing out that period if you've got that period, that if you've got that time to do so, and we'll touch on a little bit later some circumstances where you might not. And I guess Tim's been doing a lot of work in this area already, and there have been situations such as with significant ill health, where it just makes sense to try and exit the pension because they want to wind up the fund and so on and so forth. I think the other thing to mention there, Tim, as well, is we've already touched on the fact that one component to these pensions was around asset test exemption. The other part to this was the fact that these were built off the old pension RBL, or the higher reasonable benefit limit. Those that may be old enough to remember RBLs, we have in essence two types of pensions that were really established, or two reasons why these pensions were established initially. So maybe, Tim, before I touch on some of this analysis, just a quick summation of that pension RBL side of things.
Yeah, so I guess the quick summation of the pension RBL was to entitle yourself to tax concessions back pre-2007. Your superannuation benefits were measured either against a lump sum RBL or a pension RBL, and the pension RBL was in effect double the value of the lump sum RBL. So it meant that you could have twice as much money in super as long as you locked half of it away into one of these compliant pensions. It meant that you got all of the associated tax concessions, which back then was you got a rebate to offset your marginal tax liability. But it just basically meant that that by complying, hence the word complying, by complying with the RBL requirements, it meant that that you got the tax concessions. But one of the big issues was you were locking the capital away in return for an income stream on these large sums of money. So often when we're talking about these compliant pensions, we're actually talking about values, you know, $1 million plus type funds. I mean, the largest one I've seen in recent times is about 20 to 30 million, but I do know that there actually are larger ones out there with regards to these RBL pensions.
Yeah. So decisions around whether to undertake the commutation, there are a number of factors that need to be contemplated and I guess analysed with the clients. And we've touched on a couple of these things already on the basis that it is a full commutation. So the big benefit to these measures is that for a lot of clients, they haven't had access to the capital because of the complying nature of these products. So understanding how important access to that capital is naturally going to be one of the most important decisions in undertaking that commutation. Looking at that asset test exemption, as we've touched on, so what impact does it have that any adjustment to this would ultimately mean that the asset that was previously excluded either at 100% or 50% under the asset test exemption would now get caught into that assets test and looked at differently to the way that the rules apply today. Some clients with those large balances that Tim was talking about, they would potentially have amounts currently caught under the defined benefit income cap, and therefore certain amounts would be accessible to them, taxed at marginal rates, but they're getting, because of the nature of the income that's being paid to them and the fact that that pension couldn't be commuted, all of that pension, the asset supporting that pension, was effectively exempt within the fund. So again, timing of when you might undertake this, if you're going to look at it, may be important. So noting that, we then have some differences around the timing and what happens in the event of a member's death, and therefore the components that we talk about so often when we look at income streams and the proportioning rule there as well. We're going to delve into this a little bit more when we look at transfer balance account reporting as well. So this is a significant issue, in particular those pre-1 July 2017 pensions, where they are treated as cap defined benefit income streams. So in that respect, again, we need to understand how much we may be able to get back into the retirement phase. And therefore, when we start to factor in all this stuff, we then also look at, well, the timing of when we might actually undertake things, because if we can't get stuff back into the retirement phase in its totality, well, then maybe we look to sell down assets first. Are we going to maybe in specie assets around potentially, if we're paying it out under a death benefit because of a reversionary pension, for example? So there are a number of factors that we need to consider. And when we drill down on this even further, what we also need to understand is we need to look at the governing rules of the fund. So one of the things that Tim touched on before there around the potential of two debts being raised was around the fact that even where you may update the governing rules of the fund, that in itself could taint the actual accounting of that amount under the clawback provisions that we'll talk about through that legislative instrument. What we're fundamentally looking at here with the deed requirements is that these are all pensions that were non-commutable that we are now allowing a commutation to occur. If you go back and have a look at deeds from early 2000s through to the mid 2000s, we then have very specific clauses within those deeds around the types of pensions that could be paid. Why? Because we needed to specifically outline this detail for Centrelink to be able to provide that asset test exemption, most importantly, at that point in time. So we will need to be able to make adjustments somehow, either by the deed or potentially in the terms and conditions of the pension, to ensure that we can commute that non-commutable income stream. Tim touched on that reversionary versus primary beneficiary, because it does matter whether it could roll back or whether it would ultimately need to be lump summed out. We'll say that the reversionary, and there is a question there from Pamela around if it's a reversionary, it's not that it has to come out as a death benefit lump sum, but we need to understand with a death benefit, we have the choice of either commencing an income stream with that amount or lump summing it, i.e. we don't have the ability to ultimately have that amount retained within the accumulation interest of that individual. And again, finding out the dates around the timing of when that pension commenced, because that will determine whether it's treated as a cap defined benefit income stream for transfer balance cap purposes or an account-based pension ordinarily. And I think, Tim, you were having a discussion earlier this week with someone where they just had a question about a date with a fund that they took over. And I guess these are all the things that you need to be aware of that you have available to you as you work through this process around commuting a pension.
Yeah, I think that's it's a key issue there, Aaron, in the sense that when we are looking at what sort of pension is it. I mean, the decision for the client is quite a simple one, right? Whether they choose to commute the pension or to not commute the pension. From an administrative point of view, the key issues will come along with: is this a cap defined benefit income stream or is it an account based pension from a reporting point of view? So there's admin considerations that we have to take into account. So when we're going back and researching the fund, I mean, these things are great. If you've administered them from day one, then you're going to know all the records. But we're talking about 20 years in many instances here. And so there's a good chance that these funds have moved through multiple accountants, multiple administration firms, multiple advisors, and the historical information might be somewhat lacking. So it's important to note that a market link pension, for example, cannot have commenced prior to the 20th of September 2004. So any commencement date before that would be fund membership date, not pension commencement date. Similarly, it's not uncommon to see a pension commencement date for a market link pension after 2007, which means it would have had to have been from the commutation of a lifetime or a fixed term pension. So these dates are critical, particularly post 2017, because that will then impact how we do our reporting.
Yeah. All right, let's have a look at a couple of examples now. And I guess specifically, we're going to jump into market linked pensions. So Tim, just a few things we want to touch on before we move into our example here.
Yeah, so we've already started talking through the concept of market linked pensions and how we've already used these terms: cap defined benefit income stream and account based pensions, and these are effectively TBAR terminology with regards to how these pensions were either initially reported back in 2017 or have subsequently been reported after to 2017. So that has an impact on what we do from a reporting point of view. So we need to understand that. But with our cap defined benefit income streams, because they were previously non-commutable, so our lifetime pensions, our market link pensions were non-commutable, it meant that unlike an account-based pension where we were able to, at the 30th of June 2017, we were able to commute back to our personal transfer balance cap of 1.6 million at that point in time, We weren't able to do that with these capped defined benefit income streams. So it meant that from a T-bar position, we were often in excess of the $1.6 million, which resulted in a system being introduced, which was a defined benefit income cap, to say once you earned income above that cap, then basically you were taxed on 50% of the amount above that cap at your marginal tax rate. So it created additional admin issues that we needed to contemplate. And given that a lot of these pensions are coming towards the end of their term, it means the income is a lot higher now, or the requirement for income is a lot higher, meaning a lot of individuals are potentially borderline hitting this cap and having to pay tax on their marginal income. So creating PAYG or unnecessary PAYG obligations that previously didn't exist before 2017.
Yeah. All right, so let's jump into our example that we've got here. And we actually built this for our SMSF day recently. So Tim, I might sort of set the scene and then you can kind of go into some of the technical aspects here. But this is a likely scenario. Most of these clients are going to be much older. So we have Judy here. She's currently receiving a market-linked pension. We had a value, which was the account balance of 600,000, just over 600,000 at 30 June of the previous financial year. And we've got a tax-free proportion of 25.76%. So this is an old pension RBL based one. So she's not an age pension recipient. So Centrelink is not the issue here. And there's been no changes since we had to have this amount applied to her transfer balance account from the 1st of July 2017. Now, with these pensions, as the term starts to reduce over time, you will see that remaining term will mean that the amount of pension that needs to be drawn is quite significant. So in this instance, Judy's drawing monthly, but she has about 163,000 that she needs to take, noting with the market-linked pensions that there is a plus or minus 10% variance with this income stream that she has to, in order to, in essence, comply with the requirements of 1068. So she's come to you and said, well, I've heard about this amnesty. What do I have available to me about the restructure of this pension? So Tim, let's sort of touch on some of the implications here that need to be considered.
Yeah, okay. So look, I guess one of the first things I want to highlight is going back, just, and don't go back, but your slide about one of the key issues and the, access to capital. Another thing, Judy is highlighting one thing that is pretty critical about most of these clients. Judy's 86 years of age, and so what we understand with the majority of these clients is if they're not already in their mid to late 80s, then they're well on their way there. So unless it's reversionary pensioners, most of these clients are in the latter stages of life, and so decisions often will be made sort of with a time-sensitive nature to them. So from Judy's point of view, we've got that initial market-linked pension transfer balance credit of $1,038,840, which was a result of her annual income back that year. So what did she draw that year? Multiplied by the term remaining. She had 11 years remaining. So you'll note that her account balance back in 2017 was actually about 800,000. But because of this cap defined benefit income stream, it was a multiple based on income, not the account balance. So she had this amount for $1 million, gave her some available cap space. She put the rest of her money into an account-based pension at that time. So zero cap space left. What we also know is that since 2017, up until 30 June last year, Judy has drawn a total of $600,000 from her market-linked pension. Now that's important for when we start to look at our commutation requirements and our debit values. And then her account balance at the beginning of the year was just over 600,000, which enables us to calculate our pension. If we then move on, what we have to do from a commutation point of view and a calculation of our transfer balance account debit is, we know how an account-based pension works is pretty much whatever the value is at the date of the commutation. With these cap defined benefit income stream market linked pensions, we actually have to introduce this formula that takes our original transfer balance credit. We have to take out any other transfer balance debits that might arise or may have arisen in respect of that pension, which is in most circumstances going to be zero because there's not any debits because they were non-commutable. We then take the total amount, we subtract the total amount of super income stream benefits they are entitled to receive before the start of the current financial year, which is why that $600,000 drawdown amount is important. And then we subtract the greater of the income stream that they've received in the current year and the minimum amount that's been required. So one of the key issues that we know from a SIS point of view is if we're going to commute, we have a pro rata requirement for the current year. Now that pro rata is based on the minimum amount, which is the 10%, the variance there, the lower amount. You don't have to take 10% of the regulatory amount in that regard. So you have to factor in what is your pro rata requirement. So we've done the calculation here from Judy's point of view, and this is one of the tools that's available on our Legacy Pension Hub, is the ability to do your calculations for the market-linked pension. So you can see there that we've calculated what her income figure requirement is, the minimum and maximum range for Judy there, and then the pro rata minimum of 110,571. So Judy ensures that she's taken that amount out. But what we also can track, because if we know that the pension is a capped defined benefit income stream, we can then incorporate all of the income that we've drawn down for the years from 2017 through to the current year, and that effectively does our T-bar calculation for us. So it takes what's the original credit, the annual amounts, and then the greater amount of what's been drawn this year, or the pro rata, and it allows us to put that into that formula. $1 million less 600, take 110 from the current year, means that our transfer balance debit is $328,069. So we know that the account balance, because of the amount she's drawn down for the year, her account balance is about 522. Judy's only getting a debit for 328. So it means that she can push that 328 potentially into an account-based pension. That's her choice. That would take her back up to the $1.6 million, or she could leave it all in accumulation, or she could take it all out of super. But if she starts an account-based pension, then she's got that $194,000 available to her to either leave in accumulation or draw and take out of the super fund. And her personal circumstances are going to dictate what she does there.
Yeah, absolutely. So I guess, Jeevan, let's sort of hand over to you here just to talk about a couple of the practical things that people need to be aware of when processing these within Simple Fund 360 from the commutation standpoint, but then also with the T-bar reporting.
Yep, absolutely. So in terms of commuting the income stream, the process is no different to any others. You'll be navigating through to the members screen, selecting which pension account, and especially in the case of a member that's got multiple pension accounts, you don't tend to see a member having multiple market-linked pensions, but it is definitely possible. It's probably rare on that side though. And obviously, usually on the top right-hand corner, you can see there, hitting the internal transfer commutation button to trigger that particular wizard and following the process through in terms of commuting that through to accumulation. Or you can, obviously the other option is editing the pension itself, and obviously clicking on the button on the right hand side, you can see there in terms of commute to accumulation. It'll take you through the exact same wizard. They both just access the same wizard. That wizard then takes you step by step of actually commuting the pension at that particular point in time. Obviously, if you are commuting partway through the year, you need to create entries before this to the day prior so that the market value is up to date at that particular point in time.
Yep. And then you've got the ability therefore to use that calculator as a checking tool that we've obviously helped to build in this process, which takes us then probably to the other critical aspect of this, Jeevan, which is into our T-bar requirements, because typically we will see in this instance the account balance being the amount that will be displayed, but as we've already highlighted, that may not be the correct amount that needs to be reported for transfer balance cap purposes. So what needs to happen?
So I've got a couple of screenshots here. So the top one there, you can see what happens by default is when you enter the commutation there in Simple Fund 360, automatically the entire commutation amount, so generally being the entire account balance, will be entered as an event there into the T-bar dashboard. So obviously that's not what we want. We have calculated, as we saw before, in terms of the calculation sheet, it's actually reduced amounts. So if you do select the actual event there on the left-hand side and click on the edit icon, which I've highlighted there in the green square, on the very next screenshot there, you can see you can edit the amount to the reduced amount, hit the tick icon, which will save it, and that's the amount that we submitted through, even though it's different to the actual transaction account there as well.
Yep. Yeah, excellent. So I think that's the most, so understanding a lot of the terminology here is really important, because as we've highlighted in this example, we have this pension that is a cap defined benefit because it has a start date before 1 July 2017. Now, if it was after 1 July 2017, then it's not a cap defined benefit income stream, and therefore we're needing to look at account balance. So in that sort of just that simple example, there are a number of things that you just need to ensure you have accuracy on dates, because it is going to, in this instance, have a significant difference in terms of what should be correctly reported against that individual's transfer balance cap, and therefore determine how much of the benefits that they'll have ultimately in the retirement phase. So then we go to, well, what do we then have to do next? And this is where at Smarter SMSF, as we highlighted at the very beginning, we've built a number of tools and documents to enable you to undertake the relevant commutation. Now, we've done this in two different forms. So one is with our market link pensions, we have an online form that you would be able to complete and then have that document automatically generated for you. You can use our integration within Simple Fund 360 to do that, and I'll show you in a second how you can do that. Or if you are unsure, we do have a number of manual application forms, Excel-based. Many of you will have used Excel-based forms in the past for, say, actuarial certificates and the like. So we've done that in that sort of similar format, just so it's a way in which people have ordinarily understood. That's how it works. And as part of that process, we can then produce those relevant documents for you and give you an indication of the value that needs to be done for transfer balance account purposes. So what I'm going to do is just jump over now to our Smarter SMSF platform. And I guess first and foremost, within Simple Fund 360, you can access this platform automatically from there. So we have the connect button, and then under ordering documents, that will in essence sign you on across to our Smarter SMSF platform here, and it will be integrated for you with Simple Fund 360 when you choose that particular document. You'll see here we have the Legacy Pension Hub that is available, so you can click on that hub there and you'll see Tim and I, and what we've done on this hub is included a range of forms here. The calculator that we highlighted before has the ability for you to download. There are a number of FAQs that we've put in here. We've put some fact sheets and checklists. We've put in the references. So if you're looking for the regulations themselves, you're looking for the Social Security instrument, all these things as relevant items come to hand, we are adding to this Legacy Pension Hub as a central resource to be able to do things. Again, the video, we ran a webinar ourselves in February. Something like today's webinar will also upload, and we run sessions throughout the year with our weekly videos and stuff that we add into here for you to be able to access. But with the market link pension, you can either download that form, as I said, or you can go in and simply undertake that order from the online form. You can see there equally, it's listed in the documents page as well. So you can then see the link there, and then you can hook up to your Simple Fund 360 integration and select your client and then populate as part of that process. We don't have time to work through that today, but I just do want to also show you the form that we've created, again, capturing all the relevant information that we need to enable the documents to be prepared for you. Then once that has been prepared, in essence, that document template that we create in this instance is, in essence, a combination of the request, the fact that there has been obligations around the pension for the year. There is a number of T-bar requirements. There's relevant deed requirements. There is the obligations for asset test exemption where relevant. So there's a raft of stuff that we are including in here that we are going back and referencing in the templates that we have created. So it is important that when we are looking to undertake these commutations, that we're covering off all of these relevant steps so that when we get to audit, the auditor is comfortable that we have met the requirements here of that commutation under the provisions of the adjusted 106C, I think it is, capital C, Tim, that allow for the commutation under these regulations. So what we've done specifically within the Smarter SMSF deed is built in these additional regulations, and it allows you to therefore produce these relevant documents to ensure that they comply with, in essence, those new laws as well. So let's keep moving through because I am conscious of time. So Tim, let's sort of jump now onto defined benefit pensions. So these have more curlier aspects because we need to involve the actuary that give the ongoing solvency to it. But in some instances, they're much simpler around the commutation rules than what we had with market-linked pensions.
Yeah, so I guess the key thing with these ones here, Aaron, is that that what we're looking at is two very specific pensions. So 106.2 pensions, which are our complying lifetime pensions, and 106.7, which are our life expectancy or term pensions. And as I highlighted before, very few of those are remaining. It's important to understand that there's a third type of pension that we often see here, which is a flexi pension, which is payable under 106.6. Now, these aren't included in the commutation requirements because they're already a commutable pension. So they are applicable to the reserve allocations, but with regards to commuting, there is a very specific set of rules as to how you commute a flexi pension. And obviously you can get in contact with us if you've got any questions in regards to, if you're one of the few people that still have flexi pensions available or within your client base. What you have to contemplate is, in addition to the whole concept around asset test exemption, which we spoke about before, is there's other things you have to work out, and that is, what is the valuation requirements? How do we value this pension? And do we need to get actuarial guidance? So we don't need that actuarial guidance necessarily for a market-linked pension, but for a defined benefit pension, there might be a requirement. And a lot of that is actually going to be contingent on how the software represents these pensions. So we wanted to talk through conceptually, and this might be a little bit of a three-way conversation between Aaron, myself, and Jeevan with regards to how these pensions are actually reported. Because one of the key things is, and I'm going to touch on this in a moment, the tax office came out with quite a definitive position on these pensions in 2015. The reality is most of these pensions started, these compliant pensions, most of them started before 2004, which meant that the way that we reported them was already ingrained in our systems and in our softwares. And so, we always reported these sorts of things as a member balance, whereas the ATO referenced them more technically as a reserve as such. So you're going to have funds where you've got someone with an active lifetime pension, and they might just have a standard member statement representing them. But you might then have inactive pensions, so pensions that are ceased, and they might be recorded separately. They might be recorded as a reserve within the fund. So there's going to be different ways that these pensions are reported. And what that ultimately means is that you can't necessarily say, well, that is definitively the amount that we're commuting. We may need to get an actuary involved because there might be multiple members and they have to work out, well, if we're contemplating future liabilities and other things, what fair and reasonably represents the amount payable to that pensioner.
Yep.
Not sure if if you guys want to comment on that.
Yeah, I was just going to say, Jeevan, I think historically, because of the fact that this goes back to sort of desktop times, is that a lot of these pensions would have been set up as if they were linked to the member under those 500 codes.
Yeah, absolutely. So you see, and I guess that's part of that trade-off, because of how they want to be reported in the financials and the member statement, and they don't want to differ too much. It tends to be the case, but it may mean they need to adjust the annual return, or they may have a combination of a member account under the 500 codes and a reserve account. So it depends on how really they've set it up, as you said, historically.
Yep. All right. So Tim, then I guess the question is why are reserve allocations important here? Noting that the 5-year amnesty doesn't apply to these. These are permanent measures that are in place.
Yeah, so I think what we highlight, and I talked about that 2015 comment from the ATO just previously. So with these regulations, as we said, there's two parts to them. There's a commutation, which just gives us the power to stop the pension. But then because of the ATO's positioning, we recognise that all of these amounts in these lifetime and fixed term pensions ultimately form the basis of a reserve. So whether we report them as a member statement or whether we report them as a reserve balance, the entire amount represents a reserve. So when we go through the concept of commuting, we then have to add to that the concept of making an allocation from a reserve. So part 2 of the regulations becomes quite critical. Now, what we then get from that is, okay, well, how have reserve allocations previously worked? Well, they've previously worked by saying any allocation from a reserve is counted towards your concessional cap. So from the 7th of December, that's now changed, and all allocations from reserves will count towards towards the member's non-concessional cap. But there are then 2 exceptions to that. The first one is effectively an employer-based contribution allocation from a reserve. So that's not really relevant to what we're talking about there. And then we need to understand these cap-free reserve allocations. So what was introduced as part of these regulations was the concept that we have 2 distinct styles of reserves. We have our standard reserves, and we can have cap-free allocations from a standard reserve if less than 5% of the member's balance is allocated, and it's allocated to all members on a fair and reasonable basis. So that's the same rule that previously applied with reserve allocations. But we've now got this definition of a pension reserve. So it's been introduced into through the regulations of what a pension reserve is. And in very simplistic terms, any reserve that was put in place to support the payment of a defined benefit pension is a pension reserve. And any allocation from that reserve to the recipient of the pension will be a cap-free allocation. So this gives us the ability to, under Part 1, stop the pension, and under Part 2, allocate the entire balance to the member without any cap ramifications. Now, the key to this is that it only applies where the member is still alive. So if the member has passed away and we're making an allocation from a reserve that supported that pension, then it will be subject to the fair and reasonable rules or subject to the non-concessional contribution cap, which in the end is quite positive because our non-concessional caps are a lot higher than the concessional caps.
Yep. So Tim, let's jump into another example here that we covered at our SMSF day with Malcolm, who has a lifetime complying pension in place.
Yeah, and look, in the simple sense of Malcolm is Malcolm had a pension. It was paying $130,000 back in 2017. It's indexed at 5% each year. So the very simple factor requirement back then was income times 16. So 2 million was his transfer balance credit at that point in time. The current value is 1.538 million. So that's what's currently sitting within the reserve of the fund. Malcolm wants to commute his pension, so he makes the decision to commute it. And this is where I can get a little bit technical, so we won't spend too much time on it. But again, if you've got a pre-1 October 2003 lifetime pension, then there is no minimum pension obligation because the minimum pension requirements came in from that date, from October 2003. But it's treated a little bit like the account-based pension there, and you have to do the pro rata for those more newly commenced. And I say newly for September 2004 onwards, basically. But Malcolm can commute his pension, and he gets a debit to the value of the original credit. So this is significant because he actually gets a credit for debit for 2 million because that was the original credit. So very different and very easy compared to the account-based pension from a market link point. So it means that Malcolm has the full 1.6 cap space available to him. So when we actually look at what his options are, he can actually commence a pension with that full allocation if he chose to. Now, in Malcolm's case, he's the only member in a complying pension in the fund. So from an allocation point of view, it's quite simple to do. So the actuary might determine what the value is. But if Malcolm and, let's say, Judy in this instance were both receiving complying pensions, then you'd need to get that actuarial certificate to determine what is fair and reasonable allocation, or an actuarial report to determine that fair and reasonable allocation between Malcolm and Judy. But for a single member sole defined benefit, then the valuation that's supporting the account balance may in many instances be acceptable. So Malcolm could commence an account-based pension for the full value of that reserve allocation, that 1.5, because it's under his 1.6. Could take the money out of super, or he could leave it in an accumulation interest. So it is a lot smoother in regards to the allocation side of things once we know what the valuation is that we're working with.
Yeah, so Tim, I guess one of the things here, going back to the decision points that I talked about at the very beginning, was around timing of when you make decisions. Because in this instance, when we look at Malcolm, we have a situation whereby his existing defined benefit income stream would have an element that is exempt from tax and an element that is subject to tax, i.e. the reserves that are supporting mortality risk and investment risk and any surplus to that. Whereas if he commutes that and we in essence get the debit equal to the original credit, he can then move all that money into the retirement phase, and therefore all of his assets supporting that retirement phase benefit is in essence in pension phase, and therefore would be a better tax outcome if there was a decision being made to effectively exit the fund at some point in time, or even just make decisions inside the fund in accordance with the fund's investment strategy. So I guess that's what we were trying to highlight at the very beginning is you need to be cognizant of which way the deck chairs might move, because in some instances there will be benefits to make some decisions before you commute, and there'll be other examples where there'll be benefits to be made after commutation and restructure. And I guess we've highlighted both of those two aspects with the different examples today. So again, going back to what we've done in terms of the lifetime complying, we haven't, given the quantum of these, we actually haven't built anything specifically as an online form to be able to order that, but we have, as you can see on the screen here, we've also built a lifetime complying form, application form, in which we can capture that information from you to enable us to prepare that relevant paperwork. Now, there will be additional things that we'll need to get here. It may be the actuarial certificate itself. You may work with the actuary to obtain some other sort of report. Again, we will have the option there for you to be able to work with the actuary if you need to. I know some people go through the actuary themselves to be able to get that stuff, but there are a range of, I guess, options there for you. But most importantly, you have, through our Legacy Pension Hub, the ability to download and access that manual form so that we can actually go through and build those documents for you in accordance with not only these regulations, but the deed and as the laws currently allow for. So I guess as we get towards the back end of this, Tim, we didn't really have time today just to touch on a couple of these other areas, but these are absolutely relevant to these reserve allocation rules.
Yeah, absolutely. And look, just to answer, I know we've got a few other questions, but one that's sort of linked with what you've just highlighted there. Do these documents support deeds other than the Smarter SMSF deed? Absolutely. So we've written the documents to support both the Smarter SMSF deed, but also deeds with your own clauses or more generic statements around what deed a client might be using. So other things that we need to consider is, yes, flexi pensions and life expectancy pensions have different sets of rules around their commutation values. As I said, life expectancy pensions, probably there's only a handful of them left. And so if these pensions have ceased, so if you have a flexi pension or a life expectancy pension where you've commuted it under other rules, then those reserves, if you are allocating them now, then that allocation is still a cap-free allocation. So the question's often raised, well, if our fixed term pensions ceased 4 years ago, and we've been allocating monies from those reserves on a fair and reasonable basis under the 5% rule up until now, can we still treat it as a pension reserve? Absolutely. What it means is that from the 7th of December, if you allocate to the pensioner, it will be a cap-free allocation. All previous allocations will be excluded. But once you make an allocation to the non-pension member, then you tarnish that reserve, and it will ultimately then be subject to the 5% rule moving forward, or the NCC amount. So be very careful, but yes, you can quarantine and allocate to the pensioner now. From a fund reserve point of view, why do we have reserves? Self-insurance, anti-detriment, investment smoothing, all sorts of reasons that people utilised for whatever purpose previously and generally before the introduction of the transfer balance cap. Those reserves are also subject to these measures and are subject to the 5% fair and reasonable, less than 5% fair and reasonable allocation. But importantly, and this was a big issue when we did the consultation with Treasury, the fact that they're allocated and measured against the non-concessional cap just gives people the capacity to move more money out of these reserves. So Treasury the government don't want these reserves, right? So by aligning them to the non-concessional cap means people have a greater capacity to move money out based on their cap, but also if they move it out and they have zero cap space because of their total super balance, then all they're doing is creating excess non-concessional. And we know that from an associated earnings point of view, the tax arbitrage there is far less problematic than it used to be. So it gives a lot of opportunities.
Yep, absolutely. So I think just as we get to a close here, just to explain, if people are looking at using, most importantly, the manual forms, when it comes to the actual Legacy Pension Hub here, what we have done is the ability for you to not only download that form, I should say, but then you can submit that request to us. So we've built a process here that in essence, once that information has come through and subject to what you are requesting, we have then built through our ticketing service the ability for you to be able to track that. And then ultimately you'll be dealing with Tim and or myself in respect to the preparation of those documents as well. So there is a process for you to go through, but if you do want to do things like ordering the market link pension or even deed upgrades and stuff, all that stuff is readily available. And then once you have completed that order and then paid for that, or unless you are a Smarter SMSF subscription holder, those amounts would just be deducted off your counter for that particular order that is undertaken. So just a bit of an explanation there. You can go and have a look at that in more detail when we share the slides with you after today's session. Importantly as well, for those that may want to look at those deed updates, we also have the ability to request that legal review or Smarter legal sign-off that we have through our partner Hill Legal as well. So there's I guess a number of FAQs that might come about, and we might sort of just bypass these because I'm assuming as well through the questions, I might come back and see if we answer these as part of the questions, and if not, I'll come back and talk to those more generally. But just in terms of how we are getting, I guess from here, what are the takeaways that you need to be contemplating as a result of today's session? So most importantly, the amnesty, the 5-year amnesty to commute these is currently in place. Okay, the clock is ticking on that period, but there are a number of important steps you've got to work through with your clients first. That includes things like the asset test exemption. Waiting for that certainty, I think, is important, but there will be circumstances, we're seeing it already, where a client's health might bring that forward around the importance of sorting that out, or the balance of that pension is such that it doesn't warrant having the self-managed fund anymore. And therefore, the cost of maintaining that into the future is going to be more than what it may be in terms of the benefit that from an asset test exemption point of view. So therefore, getting that done before 30 June potentially makes sense. I think the other two parts here is every decision around the decision to commit is going to ultimately sacrifice in something, whether it's from an income point of view, whether it's a tax perspective, or there's some other concession. But it's a double-edged sword, because it's probably going to provide some sort of beneficial outcome, whether that's access to the capital, but it could also then relate to income and tax as well. We've highlighted today the importance of and the nuances of the transfer balance account, and understanding that the T-bar requirements are very different in the relevant circumstances. Reserve allocations, the concession that they've provided now is quite generous, moving that from concessional contributions into a combination of cap-free allocations and then NCCs, noting that many of these clients are much older, and the longer that it gets along, the more problematic that these funds will ultimately be. And I guess what we've tried to highlight for you today here is that our expertise and knowledge in this area is something that we obviously hold ourselves to a very high standard on. And that's why we build not only education solutions around these types of topics, but then also the compliant documents and tools to then assist to navigate through regulations that come about, such as with these retirement legacy products.